There are so many infinite banking policies out there, but what do the best ones actually look like? And at the very end here, I'm going to show you a real life scenario of what a policy looked like from somebody else who did one versus what we actually do and how vitally different it really is. Okay, the first thing you need to know is the company a mutual company or a stock company? Now, you may not know this, but stock companies, which are like the companies that are traded on the stock market, like your MetLife, for example, right? These companies, they pay dividends to those stock shareholders. But in mutual companies, they're kind of like credit unions. Credit unions will pay back the money to their members versus paying to the shareholders. At banks, same thing here. Mutual companies pay back to the policy owners. So those that actually have whole life policies, the more profitable a mutual company is, the more that they can pay dividends to you as the policyholder. So what's kind of cool is, many times they'll tell you how to buy term and invest the difference, right? Well, did you know that term insurance is one of the most profitable, actually it is the most profitable life insurance that a company can sell you. Why? Because only about 1% of policies ever pay out. So when people buy term insurance, most of them never pay out and they bank on it, literally bank on it. Well, what I like to tell people is when you have a whole life policy with a mutual company, the cool thing is you get the benefits of everybody not dying. You get those benefits in your policy because you're making part of those profits too. So it's kind of nice. So mutual companies are really key. Number two, I mentioned about dividends, but it's not about the dividends. It's the cost of the policy that really matters. Many, many times I've seen situations where someone says, oh, well, this company says they're paying X number of dividends, right? They're paying this high dividend. I said, well, that's great, but what's the actual cost coming out? Did you know I actually had one company I worked with where they would only pay a 1% dividend. Yeah, because their costs were lower, they were beating dividends that were like 6, 7% at that time. Now, it's not because their dividends were amazing, but it's the cost. Think about this. If the costs are even just 10% less and they only pay 1%, that other company would have to pay 11% to keep up with it. So it's not really about the dividends. Of course, all things being equal, it is. But it's really about what's the underlying cost. How much insurance costs are coming out of that policy? That is the number one determining factor about whether you get more cash value, that bigger savings account, or not. It's always about that. So remember, dividends are important, but it's the cost that makes you the most money. Now, the third thing here is that which one really gives you the highest cash value? This goes along with the second one I just mentioned, right? The highest cash value, in my opinion, is the one that wins. So many times people say, well, can you show me like all these underlying expenses and how this breaks out here and there? I said, it doesn't matter. What ultimately matters is how much money do you have back? How much cash comes back to you? And so many times people will get caught up in those kind of things like, what's the cost? Well, just look, what's the net gain or cost of your own policy? So I've seen people out there do videos on infinite banking. They'll say, oh, you do like 60% or 90%. In fact, I'll give you a bonus one right here. There are a policy that I can actually write that's a 90%. That means there's only 10% cost coming out in the first year. You get 90% of whatever you put in that first year, which is the most expensive year. Or is it? That interesting thing about that 90% one, which actually is from Mass Mutual, another good mutual company. Here's the interesting thing, is that Mass Mutual also has another product that's their traditional whole life product. Well, guess what? That traditional whole life product, after about 5 years, beats the 90%, even though it may only have 75% in the first year. So that means 25% comes out in costs, 75% goes back to you. But guess what? After 5 years, apples to apples, you have still more in that policy that took out 25% versus the one that only took out 10% the first year. Well, Chris, how is that possible? The reason it's possible is because of this. They just spread out the costs, right? I heard one guy on a YouTube video say, he said, well, it's because they pay the agent less. That's true. In the first year, they pay the agent less. But in those following years, they keep paying the agent consistently. They pay them more over those following years. Where some policies do a larger upfront cash coming out in the beginning, they'll pay you more in the beginning, but then they'll pay the agents much less at the end, right? Just so you know, if you want to understand how agents get paid, they get paid off the cost of the insurance policy, which means the more you have in cash value, the less the insurance agent gets paid. That's basically how you do it. My goal is how do I get ourselves to be paid as little as possible on a given policy? I'll tell you, there's a little bit secret to that, a little method to my madness that actually doesn't pay us less, but still pays you more. But that might be for another video. I'd love to hear your thoughts. Let me know in the comments if you have looked into life insurance and what questions you actually have about these too. All right, so you're probably wondering, okay, what does that really look like? Well, let me just show you an example. This is actually sent to us by a client. The funny thing is they were actually about to pull the trigger on this. They were about to buy this Northwestern Mutual policy. Now, Northwestern Mutual is a mutual company, right? They've been around a long time. They're a very strong, solid company. They're also strong and solid because they charge a lot in expenses too. That's why they have so much profit. They don't always pay the highest dividends, but their costs are definitely higher. Okay, so let's look at this apples to apples comparison we did with these people here. So this is the Northwestern Mutual policy that they had and that they were offered. And they felt great about it. They thought, this looks good. This is infinite banking. We're doing it. Well, guess what? Look at that first year. You'll see that after they put in $22,000, they have $446 in there. $446. That means that basically almost all $22,000 is going to insurance costs. That is what the agent gets paid on. Right? Now, that's not uncommon. For most whole life insurance policies, usually the first year you have zero. Second year, you might have zero as well. So at least by the second year, there's $3,300. So there's a little bit of extra here, but not a lot. So, and you can see even down here, down the road, the break-even point, you can see how much they've paid into it. Right here, year 14, they've paid in $309,000. They now have $325,000. So now they finally surpassed having more. But it took them 14 years to have more in cash than what they've paid into it. Now, look at the difference here. Here's ours, apples to apples, doing the same thing. And again, I'm just using my own numbers here, so this is the situation for them. I just made myself 43 years old like they are. Now look, that first year, it's not $400. That total cash value is $17,285. So pretty much they have $17,000 more. Why? Because we made the cost $17,000 less. That's why. So they end up getting a bigger benefit here. And you'll see the break-even point. Here we're almost there. They put 110,000, they got about 109. Here they blow through it by year 6, 132,000, they got 136,000. Now check this out. Now this is not just a big deal, in that sense that it's saving you $1,000 even from day one, right? But look at this, even 20 years out. So you'll see here, age 63, they have $575,000 in it. And ours, age 63, $714,000 in it, right? So again, $575 versus $714,000. That's a $140,000 difference between the two. Putting in the same money, yet very, very different. So what's different about ours? How can you see the difference? Big thing is this, is that yes, there's cash from day one. I like it where by year 3, if not by year 4, this right here, I love this column where it shows a net gain. That means whatever you're putting into it, it's actually growing by more than what you're putting in. That means there's a zero net cost of insurance at that point, but the third year, right? Most of the time, when I used to see these policies in the very beginning, I would have to wait several years before that was the case. I mean, even on this guy's right here, I mean, you were trying to put in 22,000. For it to grow by 22,000, you really waited about, really until about the 5th or 6th year before you saw that, right? So again, everything just happens faster because we make it more efficient. Lower cost allows your cash to grow faster. That allows you to be able to leverage the policy faster and make more with it. That's a crucial, crucial point. Now, how can you really know if you're gonna have the best? Well, you have to have a true apples to apples comparison. You really have to have it being apples to apples. I've seen some people come back with apples to apples comparison saying, look, and they beat your numbers. And by the way, our promise is we will beat everybody's numbers, or at best, maybe somebody will match our numbers, but we always beat numbers. But there's a situation where somebody's numbers didn't beat ours. I looked at it more closely and guess what happened? They had to break it. They had to turn it into a taxable life insurance for it to actually work, right? So they lost the tax-free status and everything, and then it's like, look, now we beat it. Yes, you had to break it. And many insurance agents, when they see our stuff, they're like, I don't know how they can do that. It's impossible. There's no way. They must have made it taxable. They had to turn it to a mech, as they call it. Nope, we didn't. We just are dang good at what we do, right? And that's why. We want to get the best ROI on the cash value possible. So here's the thing, often we get these kind of scenarios. I'll tell you another one. There was a dentist that between him and his wife, they're putting in $150,000 a year with a guy that was an infinite banker, a popular infinite banker for that matter. And as we're looking at the numbers, at first I said, you know what, it's probably good. You've had it for 5 or 6 years. Don't mess with it. But they said, well, can you look at it anyways? And so we did. We went and did a comparison, apples to apples, and my mind was blown. I was shocked. When we did apples to apples scenario, I saw that after 20 years, they would have, I kid you not, $2.25 million more in our policies versus theirs. Even though they already paid the biggest dues in those other policies and it was supposed to be growing more, we still beat it with a brand new policy. $2.25 million, guys, $2.25 million more. And of course, the argument from some insurance agents are, well, yes, but they had to cut the death benefit. Yeah, we did, but guess what? After 20 years, they still had about $4 million of more death benefit too. So they had more cash value, more death benefit, everything was better. Needless to say, they switched over, right? So how can you really tell? It's hard to tell. The best thing I can say is you can always reach out to us at moneyripples.com and say, hey, we got these numbers. Can you run a comparison? And we'll give you an honest opinion. If somebody did a good job, we're going to tell you. I've even had some people that I said, it's close, it's not quite, but tell them to do this on this scenario, because we're also with those same companies. I said, go do this with that scenario and you'll get a better ROI. I had one guy that did that, saved him a couple $1,000s a year and went and did it anyways and ended up making it work in his benefit. It actually ticked off the insurance agent because he said, I just lost commissions because of you. I said, no, you didn't, because the guy decided to do a bigger policy and you got paid more, so shut up, okay? So that's the thing, is that it makes everybody's life better when you get a good, well-designed policy, right? But it's gotta be in your best interest, not the insurance agent that's trying to make a commission. So guys, if you're interested about this, you wanna go down this little infinite banking rabbit hole, check out this next video. How much money do you really need for this infinite banking concept? Check that out.